Rivian Automotive Inc., trading under the ticker RIVN on the Nasdaq, is currently priced at $14.22 as of the market close on Friday, May 8, 2026 at 4 p.m. EDT. Throughout the final session of the week, the stock experienced a modest intraday gain of 0.20%, moving between a low of $13.84 and a high of $14.35. While the primary trading session saw this slight upward drift, the after-hours activity showed a marginal cooling, with the price settling around $14.21 by late evening. These figures reflect a market that is essentially catching its breath after a period of intense volatility following the company's recent first-quarter earnings release and several high-profile strategic announcements. The immediate reality of Rivian's current standing is a fascinating study in conflicting signals. On the surface, the market appears cautious, but beneath the quiet price action lies a development that many investors have overlooked. The company recently secured a massive $1.25 billion investment from Uber to deploy up to 50,000 fully autonomous robotaxis. This is an insight that fundamentally shifts the narrative from Rivian being a struggling hardware manufacturer to a key player in the autonomous transportation network. Most retail investors are still focused on delivery counts and quarterly losses, but the institutional shift toward valuing Rivian's software and integrated platform for fleet services is the hidden reality that is currently battling against the expectation of continued cash burn. There is a common belief that Rivian is merely a luxury alternative to the Tesla stock narrative, a niche player destined to struggle with high production costs and a shrinking pool of affluent buyers. This expectation has kept the stock pinned near its lower bounds for months. However, the deeper reality revealed in the latest financial reports suggests a structural pivot. Rivian actually beat earnings per share expectations this past quarter, reporting a loss of 0.33 cents against a much bleaker forecast of 0.63 cents. They also managed to squeeze out a consolidated gross profit of $119 million, a milestone that was largely overshadowed by the headline news of negative free cash flow. This creates a tension where the general sentiment remains bearish because of the cash burn label, while the internal unit economics are quietly moving toward a positive inflection point for the first time in the company's history. When we look at recent stock movement and trading volume, we see that institutional activity is becoming increasingly polarized. Major players like Vanguard and Baillie Gifford have maintained massive positions, with Vanguard recently reporting over 36 million shares in its portfolio management arms. Yet the daily swings are being dictated by macroeconomic pressures, specifically the higher-for-longer interest rate environment that punishes capital-intensive businesses. The trading volume has been averaging around 32 million shares, showing that there is plenty of liquidity for those looking to exit or enter. If you are using an individual brokerage or exploring the various investing sites available today, you've likely noticed that the volatility in RIVN is significantly higher than what you might find in broader indices. This is a stock for those who understand that the expectation of a smooth ride is a fantasy. The reality is a gritty, high-stakes fight for market share in the midsize SUV segment. The recent sector momentum for electric vehicles has been lackluster, which is why Rivian's decision to increase its Georgia plant production capacity by 50% is such a bold move. They are aiming for an annual capacity of 300,000 units for their R2 platform. This is where the narrative of expectation meets the wall of execution. The market expects Rivian to struggle with the scale-up, similar to how early Tesla stock faced production hell. The reality, however, is that Rivian is leveraging a more mature supply chain and a massive $4.5 billion DOE loan to de-risk this expansion. For those managing their own self-investing through platforms like Robinhood or SoFi Invest, the question is whether the current $14 price point accurately reflects a company that is essentially being rebuilt for mass market dominance. Comment below how many shares of Rivian you currently hold and what your average cost basis is. Do you believe the partnership with Uber will be the primary driver for the stock in 2027, or are you more focused on the R2 launch? Taking a closer look at what the company actually does beyond the flashy headlines, Rivian is an automotive technology firm that manages the entire life cycle of its vehicles through vertically integrated software. Their business model isn't just about selling a truck, it's about the ecosystem of services, insurance, and charging that follows. This is a key distinction. When you look at Apple stock, you aren't just buying a hardware company, you're buying a services giant. Rivian is attempting to mirror this by reporting a 49% increase in software and services revenue this year. While the automotive segment still faces gross profit challenges due to reduced regulatory credit sales, the recurring revenue from their fleet management software and the Rivian Adventure network of chargers is starting to provide a floor for their valuation. Older reports from late 2025 indicated a much more precarious position, but the Series A capital raise and the $1 billion equity investment from Volkswagen Group have significantly bolstered the balance sheet.
They ended the first quarter with roughly $4.8 billion in cash and total liquidity exceeding $5.3 billion. For someone utilizing investment help or an intelligent portfolio, these liquidity metrics are paramount. They provide a runway that many other EV startups simply do not have. If you look at interactivebrokers or Fidelity for deep dive technicals, you'll see that the interest coverage remains negative, but the current ratio of 2.10 suggests they have the short-term assets to cover their obligations as they transition to the R2 platform. Past performance shows a staggering 88% decline from its all-time highs reached shortly after its IPO in 2021. That historical context is vital because it informs the scars on the current chart. Investors who bought at the peak were operating under the expectation that Rivian would instantly become the next trillion-dollar company. The reality was a painful lesson in the difficulties of automotive manufacturing. Today, the stock is trading at a price-to-sales ratio of about 3.18, which is significantly lower than its historical average. This valuation shift suggests that the hype has been almost entirely bled out of the stock, leaving behind a company that is being priced more like a traditional industrial firm than a high-flying tech play. As we look toward the future, the outlook is dominated by two major catalysts: the production ramp of the R2 and the deployment of the Robotaxi fleet with Uber. The risk, of course, is that negative free cash flow, which was a staggering $1.07 billion this past quarter, will continue to dilute shareholders if another capital raise is needed before the Georgia plant is fully operational. This is the ultimate expectation versus reality trade. The market expects more dilution. Rivian's management is betting that their improved unit economics and software margins will bridge the gap. For those using online investing tools or a Fidelity brokerage account to build a long-term position, the volatility is the price of admission for a potential turnaround story. Scenario-wise, if Rivian can maintain its current delivery pace and show a narrowing net loss in the second half of 2026, we could see a massive short squeeze. Institutional ownership is still high, but short interest has been creeping up as speculators bet against the company's ability to reach free cash flow positivity. The reality of their manufacturing efficiency, specifically the focus on design for manufacturing, which aims to reduce non-BOM costs by 50%, is the lever that could break the bearish narrative. Whether you prefer the simplicity of the Robinhood app or the robust features of the interactivebrokers platform, keeping an eye on the cost per vehicle metrics will be more important than the total revenue numbers in the coming months. In summary, Rivian finds itself at a crossroads where the market's expectation of failure is being challenged by a series of high-level strategic pivots. The live price of $14.22 reflects a wait-and-see approach from the broader market, yet the underlying reality of their $1.25 billion Uber deal and the $5 billion plus in liquidity suggests a company that is far more resilient than their stock price indicates. We have seen a narrative shift from luxury truck maker to an integrated autonomous platform provider, and while the path to profitability is still uphill, the structural improvements in their business model are undeniable. The contrast between the historical peak and the current valuation provides a sense of depth and authority to the idea that Rivian is no longer a story stock, it is now an execution stock. The gap between what investors believe about their cash burn and the reality of their operational milestones is where the opportunity and the risk truly lives. Maintain focus on the R2 timelines and the Georgia plant expansion, as these will be the definitive markers that determine if Rivian can finally transcend its past and secure its place in the next generation of transportation. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, unpack with your friends, bell sign for more updates.